In my opinion, there are two categories of investors in the world: the ones who let their emotions dictate their financial future, and the ones who rely on logic and discipline. If you're watching this video, you're probably trying to be in the second category. But here's the harsh truth: even logical investors are quietly destroying their own wealth without even realizing it. You see, everyone talks about the stock market like it is a casino where you either pick the winning stock or you lose everything. But that is not how real wealth is lost. Real wealth is lost through a series of small silent mistakes that compound over time. What makes these mistakes so dangerous is that they usually feel harmless in the moment. Waiting a few years feels reasonable. Paying a slightly higher fee feels irrelevant. Selling after a sharp drop feels responsible. Skipping a few monthly contributions feels temporary. But investing is one of the few areas in life where small decisions, repeated consistently, create massive long-term consequences. And this is why so many people underperform. Not because they are unintelligent, not because they pick the worst ETF on the market, but because they keep interrupting the compounding process with emotional decisions, unnecessary complexity, and bad habits. If you can avoid just a handful of these mistakes, your portfolio does not need to be impressive in the short term to become very powerful in the long term. In this video, I'm going to break down the 5 most devastating mistakes that retail investors make. These are the exact errors that keep people working until they are 70 years old instead of buying back their freedom in their 40s or 50s. If you're currently investing in ETFs or individual stocks, you're probably making at least one of these mistakes. In this video, I will show you exactly what they are, the mathematical damage they are causing to your portfolio, and the logical framework you need to fix them today. Welcome back to Rebuild Finance. This channel is about documenting a real journey to building a $1 million portfolio. If you want to learn how to compound your wealth over time without the hype, make sure to subscribe. Let's look at mistake number 1. Mistake number 1 is the most common and mathematically the most destructive: waiting too long to start. A lot of people think they need to have everything figured out before they invest their first dollar. They wait until they get a promotion. They wait until the market cools down. They wait until they have the perfect strategy. But while you are waiting, you are losing the single most powerful asset in the financial world: time. Let me show you the math, because numbers don't lie. Imagine two people, investor A and investor B. Investor A starts investing just $300 a month at age 25. Investor B waits until age 35, but tries to catch up by investing double the amount, $600 a month. Assuming an average historical return of 8%, at age 65, Investor A will have over $1 million. Investor B, despite investing twice as much money every month, will only have around $900,000. Investor B worked twice as hard, contributed significantly more of their own capital, and still lost by over $150,000. Why? Because compounding needs time to build momentum. The longer you wait, the steeper the hill becomes. Your first job is not to build the perfect portfolio. Your first job is to simply get in the game. Start today, even if it is just $50 a month, and let time do the heavy lifting for you. But there is another layer to this mistake: analysis paralysis. I see so many beginners waiting for the perfect market crash to finally buy in. They think they are being smart by keeping their cash on the sidelines, waiting for a 10 or 20% discount. But historically, the stock market spends most of its time going up. While you are sitting in cash waiting for a 10% drop, the market might rally 30%. You end up buying at a higher price anyway, and you missed out on all the dividend payments along the way. As a long-term investor, I can tell you this with absolute certainty: in the financial markets, time in the market will always brutally crush timing the market. Stop waiting for the perfect entry point, because it does not exist. This brings us directly to mistake number 2: making ETF investing entirely too complicated. When people finally decide to start, they often fall into the trap of over-diversification. You open up YouTube or read financial blogs, and suddenly you feel like you need a portfolio of 20 different ETFs. You buy a S&P 500 ETF, then a tech ETF, then a dividend ETF, then an emerging markets ETF. This is an illusion of safety. What you are actually doing is called diversification. When you buy a broad market index fund like the S&P 500, you are already buying the 500 largest, most profitable companies in America. If you then go and buy a specific technology ETF, you're just buying Apple, Microsoft, and Google a second time, overweighting your portfolio and exposing yourself to unnecessary sector risk. Investing is supposed to be boring. The foundation of your portfolio should be incredibly simple. And I think this is where many beginners get confused. They assume that a more complicated portfolio must be a more intelligent portfolio. So they build something that looks sophisticated on paper, but is actually harder to manage, harder to understand, and harder to stick with during volatility. That is a problem, because the best portfolio is not the one that looks the most impressive in a spreadsheet. The best portfolio is the one you can understand, hold through crashes, and keep funding consistently for years. For most people, ETFs should be the core of the portfolio for exactly that reason. They give you diversification, they give you simplicity, and they reduce the number of decisions you need to make. Then, later on, if you become genuinely interested in business analysis, financial statements, competitive advantages, and valuation, you can always add individual stocks as a second layer. But that should come after the foundation, not before it. You should earn complexity. One or two broad market ETFs, like the S&P 500 or a total world index, are proven to beat the vast majority of complex, actively managed portfolios over a 20-year timeline. Stop trying to outsmart the global economy. Keep it simple, buy the market, and let the elite businesses of the world generate cash flow for you. Mistake number 3 is a silent killer of compounding: ignoring fees. When you buy an ETF or a mutual fund, there is an expense ratio. This is the percentage the fund manager charges you every year to manage your money. Now, a 1% or 2% fee might sound incredibly small. You might think, if the market returns 8% and I pay a 1% fee, I still get 7%, that's fine. But let's look at the actual mechanics of that 1% over a 30-year investing horizon. Because you are not just losing 1% of your money this year, you are losing the compounded growth that 1% would have generated over the next 3 decades. If you invest $500 a month for 30 years at an 8% return, you end up with about $750,000. But if you pay a 1% fee every year, dropping your net return to 7%, your final portfolio value drops to $610,000. That tiny 1% fee literally robbed you of $140,000. That is money that belongs to your future self, and you gave it away to a fund manager who likely underperformed a basic index fund anyway. When you are selecting your core ETFs, always check the expense ratio. You want to see numbers like 0.03% or 0.07%. Never pay a premium for a product you can get almost for free. You have to ask yourself, why do people voluntarily pay these massive 1 or 2% fees? It is because the financial industry has convinced them that an expensive fund manager in a suit can predict the future and beat the market. But the data is completely ruthless. Over a 15-year period, nearly 90% of actively managed funds actually underperform the basic S&P 500 index. Let that sink in. You are paying a massive premium and sacrificing hundreds of thousands of dollars of your future wealth to mathematically guarantee that you will perform worse than a simple, boring ETF. Wall Street gets rich on your fees, whether your portfolio goes up or down. Stop funding their bonuses. Mistake number 4 is where retail investors completely destroy their own wealth, selling during market crashes. Over the last few years, we have seen massive volatility. We had the geopolitical whiplash in the Middle East, the terrifying spike in inflation, and the sudden fear of aggressive interest rate hikes. And every single time the market bleeds, the natural human instinct is to hit the sell button. You want to move to cash and wait for the dust to settle. But if you watch this channel, you know I am fundamentally opposed to that. The stock market is a forward-looking pricing engine. By the time the news is positive and the dust has settled, the market has already recovered. If you sell during a crash, you are simply locking in your losses and guaranteeing that you will miss the recovery that always follows. Volatility is the price of admission in the stock market. And this is something every ETF investor needs to understand early. A market drop is not automatically a sign that your strategy is broken. Very often, it is simply the emotional cost of being a long-term investor. If your ETF represents hundreds of productive businesses, then short-term price declines are part of the journey, not proof that the journey was a mistake. The problem is that beginners often experience their first real correction without a mental framework for it. So instead of seeing volatility as normal, they interpret it as danger. And once that happens, they stop thinking like investors and start reacting like frightened spectators. That is why your behavior matters just as much as your asset allocation. A simple ETF strategy can work extremely well, but only if you give it time and only if you stay invested when everyone else is losing their discipline. Elite businesses present in your ETF like Amazon, Google, and Microsoft do not stop generating massive free cash flow just because a political headline is scary. When the market panics, it offers you these cash flow machines at a massive discount. Do not be the person who sells their best assets at the bottom. Be the logical investor who steps in and buys the fear. And finally, mistake number 5, the one that prevents good investors from becoming great investors: being inconsistent. You cannot build a $1 million portfolio by investing heavily for 3 months, getting bored, and then stopping for a year. Wealth is not built by intensity, it is built by consistency. This is why my philosophy on this channel is ABB. Always be buying. You need to remove the emotional friction from investing. Set up automatic transfers to your brokerage account on the exact same day you get your paycheck. Treat your investments like your most important monthly bill. If the market is hitting all-time highs, you buy. If the market is crashing and everyone is terrified, you buy. By consistently dollar cost averaging into the market, regardless of the macroeconomic noise, you are guaranteeing that you buy more shares when prices are cheap and fewer shares when prices are expensive. And the best part is that it is a completely automated and emotionless strategy. The biggest enemy of consistency is manual friction. If you have to manually log into your brokerage account every month, look at the red and green numbers, and physically click the buy button, you are eventually going to fail. Why? Because on the months when the market is crashing and the news is terrifying, your brain will find an excuse to skip just this 1 month. You will tell yourself, I will just hold this month's contribution in cash until things look safer. That one skipped month turns into 6 months, and suddenly your compounding machine is broken. You have to remove your own willpower from the equation. If you have to think about making your monthly investment, your system is already flawed. And to me, this is where investing becomes less about knowledge and more about identity. You do not build wealth by occasionally acting like a long-term investor. You build wealth by becoming the kind of person who invests consistently. Almost by default, that means your contributions are not dependent on motivation. They are not dependent on headlines. They are not dependent on whether the market feels comfortable this month. They are part of your system. Because the truth is, most long-term investing success is not spectacular. It is repetitive, it is often boring, and that is exactly why it works. The people who build serious portfolios over time are usually not the people making the boldest predictions. They are the people who kept showing up month after month, year after year, while everyone else kept getting distracted. If you can eliminate these 5 mistakes, if you start today, keep your portfolio simple, minimize your fees, hold strong during crashes, and remain ruthlessly consistent, reaching financial freedom is no longer a question of if, it is simply a question of when. Now I want to hear from you. Be honest. Which of these 5 mistakes have you made in the past? Let me know in the comments down below. I read and respond to every single one. If you found this video helpful, please hit the like button. It really helps the YouTube algorithm push this video to more long-term investors. And if you want to learn how to find those elite individual businesses and build a portfolio that truly buys your freedom, hit the subscribe button right now. Thanks for watching, and I will see you in the next one.